So if you've been thinking about your own estate planning, how you're going to distribute your wealth to your loved ones after you've gone, or even if you're executor on someone else's will, you need to be really clear about inheritance tax. Inheritance tax is a tax that's due on a person's wealth when they die, if it's above certain allowances. Now, even if you think you've got it sussed, HMRC, the tax office, are very keen to investigate inheritance tax on people's deaths. They have no problem opening up an investigation into someone's death and their estate if they don't feel the right amount of inheritance tax has been paid. So even during COVID, when you would have thought HMRC would have had enough on their plate to deal with, law firm Pinsent Masons found that HMRC opened 3,574 cases where they were investigating potential incorrect payments of inheritance tax. The result? An extra £254 million in revenue for HMRC. Now in this video, I'm going to be going through some of the common themes that came out of these investigations so you can ensure that your loved ones end up paying inheritance tax correctly. I'm Carl Roberts, I'm a regulated financial advisor. If you're the person who's in charge of dealing with someone's estate after they have died, one of the jobs you will have is to submit an inheritance tax return to HMRC. Now, if HMRC suspect that that tax return has been completed incorrectly, they will open up an investigation. And according to Pinsent Masons, there were some common themes as to why an investigation would be opened up. So the first theme was if an estate was valued at just below the £325,000 nil rate band allowance. So everyone is entitled to what's called the nil rate band allowance. You're entitled to be worth £325,000 before any inheritance tax is due. But if HMRC suspect that potentially you've valued the estate just below that level, they may be thinking you've done that just to ensure that you fall under the nil rate band allowance. So that could be a reason why they open up an investigation. Another theme was assets not being included in the submission. People thinking that certain assets don't have to be declared, or even forgetting about certain assets. It's amazing what records HMRC have on you. Another theme was property that appears to have been undervalued. So if someone dies with property and you've not got that property properly valued by proper estate agents, then again, HMRC may investigate. Another theme was claiming for inheritance tax relief when it was not valid. So there's certain things you can invest in or certain assets that you hold that are not chargeable to inheritance tax. But again, it's understanding what are the right assets and what are the right reliefs to apply and claiming that correctly. And finally, another theme was gifts that were made within 7 years that were not recorded and not disclosed. So whilst you can make gifts to your loved ones and other people, and that could be a good way to save inheritance tax, if you die within 7 years of making the gifts, sometimes they are brought back into the estate and the inheritance tax could be chargeable. So really important you keep good records. So the average amount of money that HMRC have been able to reclaim from these investigations is around £71,000 per case investigated. So you can see why they're so keen to open up an investigation if they feel anything's wrong with the inheritance tax submission. Now, as mentioned earlier, everyone is entitled to a £325,000 nil rate band allowance. So you can be worth that much before inheritance tax is due. But the problem is this allowance has been frozen at this level since 2009. And what's happened since 2009 is that house prices have increased significantly. The stock market, so your investments, have grown significantly since then, but that allowance has stayed at the same level. So we're seeing that more and more people, more and more estates are paying inheritance tax now because they're over these allowances. So what can you do to ensure that your loved ones are going to pay the inheritance tax correctly on your death? Well, the first thing you can do is make sure you carry out a regular review of your wills. So you ensure they're clear, they reflect your up-to-date wishes, and you're making the best of the inheritance tax allowances available to you. Another thing you can do is keep good records. So keep records of all the gifts you have made, at least in the last 7 years, but even go back further if you can. And also keep up-to-date values of things you own, particularly artifacts and antiques and things that are going to be hard to value when you're gone. You might know the true value of it, but your children might not realise. They might think it's an old ornament that's not worth anything, but you might realise that actually it's worth a lot more. So carry out regular valuations and document these and have these recorded to make things easier. And a key thing is making sure that your loved ones have access to professional help when they're completing the inheritance tax forms. So why not meet up with a professional, a good financial advisor now, who's going to look after your family in the long run, that you can introduce to your family so everyone knows who to turn to when the worst time comes. You don't want your children getting something wrong if it then means an investigation from HMRC. It's going to be a horrible time anyway. They don't want that hassle as well. So in terms of reducing your potential future inheritance tax bill, many people will leave everything to their spouse on first death. And this is fine. I mean, there's no inheritance tax implications when leaving money between spouses. That's an inheritance tax exemption. But obviously you're just delaying the inevitable till the second death. So once your spouse dies, then everything will be reviewed and looked at, and inheritance tax could be due. And the problem with leaving everything to your spouse on first death is you're not using this nil rate band in the right way. So yes, if you leave everything to your spouse will inherit your nil rate band. But as we've seen earlier, the nil rate band is frozen, has been frozen for a long time, and will still continue to be frozen until at least 2026. So your spouse will inherit another 325,000 nil rate band allowance, but like I said, it's not being used until later. So another way to plan this is potentially to use a trust. So if you left 325,000 to a trust in your will, so that uses the nil rate band, but now the money is outside of your estate in a trust. And it can then, as long as it's managed the right way, can grow tax-free outside of your estate, outside of your spouse's estate, so it will never be taxed to inheritance tax again. Whereas if you pass everything to your spouse, that same equivalent 325,000 that your spouse now gets is obviously going to be invested. It could go into property, and that's going to grow and grow and grow, but you've still only got the same 325,000 allowance inherited. So potentially there's going to be more and more inheritance tax on the spouse's death to pay on that money. But if you've used it on first death, then it's a good time to get it out of the estate, and then any subsequent growth is growing free of inheritance tax. So we call this estate planning, and it's still an essential part of someone's overall financial planning. We want to make sure you have a really good life in retirement, but we also want to make sure you're as organised as you can be when it comes to the end of life, so that you make things really easy for your loved ones and you're confident and happy that your wealth is going to the next generation correctly without a huge amount of tax being paid. I hope you found this video useful. Please don't forget to subscribe, because there's many videos coming soon on things like retirement planning, investment strategies, and also estate planning.